Thanks, Rob. Just as a quick reminder, this is going to be a shortened Q&A session. We'll have a longer one at the end. If I can ask that we keep the questions just to the material that we've already covered so far, and then we can do a full at the end. Ben?
Yeah, good morning. Ben Toro from Barclays. Just wanted to real quick follow up on some of the material just recently on the US-Canada business, and you talked about some of the things you'd look into innovate to kind of like get away more from the high fructose corn syrup business, et cetera. We've seen a little footnote that actually there was a growth caveat into it in your outlook. So just want to understand, what are your investments into innovation? What are the opportunities you're looking at to get away from high fructose corn syrup, just in light of what's the political pressure right now, certain companies making announcements? So where do you see the opportunities here, and what are the more short-term risks?
Yeah, I think Rob,
Want to take that
you
one?
want to take that one?
Yeah, I think two things. So this is not a new problem, by the way, right? The decline of high fructose corn syrup has been going on in the US-Canada market for quite some time. So it's not a new topic that we're used to. I think what has changed is innovation, somewhat of a necessity, but also market trends is, hey, there's not another plant to close. It's about what are you going to do with that plant differently in the future, right? So I think a couple things have happened within the fructose market, which, you know, we forecast maybe a 1% to 2% decline moving forward. We're offsetting that with growth in other areas like liquid dextrose and glucose. We've got a project at Argo where we're going to repurpose HFCS into glucose production based on a growing need in the marketplace. And I'd mentioned around biosolutions, advanced packaging materials in our industrial business. So the benefit, Ben, is we have that starch stream and we can make choices, right? We can make fructose, dextrose, glucose, biofermentation opportunities, and we can determine that based on profitability and opportunity. We've also have a development team that's looking at over-the-fence supply for green solutions and biofermentation, right? So that means they'd co-locate potentially at one of our plants. There's industry news out there where that's happened in a very big way, where anywhere from 800 million to 1 billion pounds of fructose will be replaced in, for example, biomag for plastic replacement as well. So it's a focus that we're looking at, but I think we've been able to demonstrate to the industry that yes, fructose is declining based on consumer preference, but we're able to pivot our resources in that grind towards those type of areas, which will keep our plants full and also continue to bring those stable margins that we have moving forward.
Yeah, I think just to build on what Rob is saying, and he said it, but I want to make sure it really resonates. Over the last 20 years, the rate of decline of HFCS has been negative 1% to 2% per year. Today, the industry, a very rational industry, is operating at high levels of capacity utilization according to one of the leading market intelligence firms in our industry that covers the corn wet milling industry, McKinney-Flavell, correct?
Yeah, I think, you know, Jim, I'll build upon that. So the term is grind utilization, right? So yes, there may be finishing capacity, but if the grind utilization remains high, upper 80s, low 90s, that means they're pivoting away from products that are declining and making things like liquid dextrose for industrial applications and fermentation, or over-the-fence supply for chemical replacement using instead of oil. So yeah, I mean, there's stable, and I think the supply-demand is in balance, partly over the last 5 to 6 years on this innovation focus, you know, on biosolutions and the whole bioeconomy within the United States market.
Okay. Kristen.
Hi, Kristen Owen from Oppenheimer. Wanted to ask more about the solutions platform. I understand it's still early days, so you don't want to dig too much into it, but just help us understand, what does the business model look like? Do you charge separately for a solutions or co-creation opportunity? Is that an exclusive opportunity? Just help us understand how we should think about that going forward.
Yeah.
Thank you.
I'm going to turn it over to Mike. I just wanted to make, you know, some comments. First of all, we have done an awful lot of work up front to define solutions clearly within our organization, representing differentiated products, representing co-creation opportunities as well. So a very strict definition. And today, based on that definition, it is not an insignificant quantity of our, or an amount of our overall Texture and Healthful Solutions revenue today. So we're starting off of not an insignificant base, and then enhancing it from a standpoint of how do we go-to-market. But Mike, why don't you take that and expand upon it
Yep.
from a standpoint of how we're approaching it?
So I think if you look at it in a few different areas. So first of all, solutions is our differentiated, highly differentiated ingredients, and they're technologies that bring significant value to our customers, and we're able to capture quite a bit of margin. That's the foundation, and we have a certain portfolio of these products. Then we evolve a little bit to always try to bring some new stuff to the market, and so we have this innovation that has been launched within a 5-year period, where we're really trying to drive that to stay relevant with customers. So that's another element where, again, we would have certain targets to commercialize that with customers every year. The next evolution, which we've gone through in the last couple of years, which also involves some acquisitions, is we acquired some systems houses that enabled us to look beyond just what we have within our own portfolio to see if we can help customers to formulate a more of recipe. And so that's the customized formulation, where it now is representing a bigger part of the solutions we bring to market. The next kind of last part of that is with these capabilities and being able to get deep consumer insights and understand consumer overall liking, which I know a number of other companies have also looked at that, but it's the piece where you start to connect that to textual preferences and to ingredients and the AI predictive formulation to be able to come up with some of these recipes. We're at the moment running pilots where we're testing to see how quickly can we work with customers to come up with these recipes to launch successfully in the marketplace. And so we're finding we're getting very positive feedback from customers. There's different ways to monetize that. It could be as a consultancy service is one area that we could look at. Sometimes it could also be not just the consultancy piece, but it could be tied into the sale of ingredients. And so I keep saying this is kind of like the head of the spear, where we're beginning to see this, where we're really pioneering. Also, you're probably aware a lot of companies are struggling to be relevant in their categories, and they're outsourcing more R&D. And so this is our opportunity to become that co-creation partner with them. And so we're trying to work out how much resources that require, how are we able to scale with these predictive tools, because it's very important that we can make sure we can do that in a very cost-effective way, and also the rate of success and the speed to customers. So we're still putting those pieces together. It's a bit too early before we want to commit ourselves too much on that, but we really do feel we're at the forefront, and being able to work with customers on this area is also enabling us to collect a lot of data to help our own innovation processes.
And then you'll also hear from Mike Leonard about how we're going to be scaling that based on the work that we're doing on predictive formulation as well, to help scale it without just incremental SG&A.
Charlie?
Charlie Rose, you're not your shareholder equation so far is not a very robust top line, but you're sort of talking about predictability and sort of managing the business in a much more aggressive way to deal with positives and negatives. You're taking out some volatility with respect to the commodity risk of the business. Can you talk about, are you trying to really talk about predictability and cash flow in a way that, how does that relate to the shareholder equation that you're trying to deliver? I'm trying to understand that a little better, because you're talking about a low single-digit top line, and maybe that translates to a high single-digit bottom line. But does that involve volatility, or does it involve more linearity going forward? And does the hedging process help that manage that volatility in a more constructive way? I'm trying to understand that a bit better.
Yeah. So first of all, Jim Gray.
And thanks.
Yeah. Okay. Yeah. Thanks, Charlie. So Jim Gray is going to actually address that. He has a slide in his deck towards the close that addresses the top line growth issue. One of the things to highlight for those of you that track us, obviously, is corn is a significant input. And so with corn costs, coming down, say 30%, there is that pass through. So naturally, our revenues would move, consistent with that. The business model, though, that we have has proven that we're able to navigate increases and decreases in the movement of corn, and yet we've continuously increased our operating income. As far as then, how we're using the cash that we're operating at record levels of cash, we're deploying that very, I think, strategically for the investments that we're talking about on how to continue to grow. At the same time, yes, we have been communicating a message over the last few years in all of our earnings calls and at CAGNY about what we have done to reduce earnings volatility in the business. And that is through expanded hedging practices, which has been a big significant issue. It's one of the things I talked to Rob about in his oversight of the U.S.-Canada business in relationship to the first Trump administration and what happened in relationship to co-product dislocations. The work that we've done has really taken the risk and mitigated the risk associated with that. So we have systematically, not just in U.S.-Canada, but looked at every corner of our business consciously, because it was feedback we were getting from the investment community, I'm talking 5 to 7, 8 years ago, about the earnings volatility and what can you do to mitigate it. So we've done that, and in addition, we manage the price movements because of the strength of our business model and how we hedge, not just corn on the front end, but for the back end on co-products.
Yeah.
So, that's what I would say.
Too, Joe, I think, Charlie, one of the things that we've seen as you looked at margin growth and Texture and Health and even LATAM, we've been able to stabilize and continue to grow that. I think in U.S.-Canada, we call it the roller coaster, right? Probably over the last 20 years of earnings. And a lot of that was related sometimes to the volatility or the hedging of not just the corn, but the raw materials or the co-products. And I think some of the things we put in place, there's still a little bit of noise, but instead of this, it's tighter like that. And that's actually delivered consistent earnings, which I think is something Jim's mentioned that we need moving forward, specifically for the U.S.-Canada food and industrial ingredients business. And we're kind of 3 years into that, and you can see we've had very healthy margin performance, and we're actually keeping the margins, which I think is something maybe different than from the past.
Okay. Let's take one more very quick question right here. Christina?
My question's for Rob on LATAM. So you talked about the GDP growth in the region, and we've had benefits in Mexico recently from the whole nearshoring trend, but that seems to be reversing now, and also remittances down, which could be more of a structural issue. So just curious about the growth algo going forward, since Mexico is such a big part of it and a profitable piece, if we do see a slowdown in the Mexican economy.
I think it's a great question, and I think with nearshoring coming out of COVID, a lot of companies did relocate there. I still think ultimately at the end of the day, they are geographically positioned like no one else, right, to benefit from the trade across the border in many different categories. So I think over the long-term basis, we feel that Mexico, from a GDP perspective, from a consumption perspective, and the proximity of the United States will continue to drive that growth. The good thing about LATAM, again, we have other options, right? So our Andean business has performed very well. Brazil has been facing some challenges economically, politically. So over the next few years, we may rely a little more on Brazil to deliver that OI growth going forward. But our forecast for Mexico continues to be very strong. Like I mentioned, we're very uniquely positioned there in the marketplace. We've got a leading position, and most of the competition comes from sort of imports or exports from the United States down there as well. So maybe not quite as accelerated growth, but we're still very optimistic because of that population growth, GDP growth, that the growth of packaged foods in the region. There's some issues with beer now, obviously with immigration in the United States. So for example, Constellation Brands has come out and made public statements where they were growing 10 to 12% in the United States. They dialed that back a little bit, but that'll be a short-term fix, where domestically in Mexico, the rates of consumption are still very strong.
Okay. So at this point, let's take a quick 5-minute break, and then we'll come back in and continue the presentations.